So good morning. This is Daen Wombwell again, and another webinar, this time talking about why illustrated rates on many of the life insurance products lag interest rates. This is particularly important right now because we're in a rising interest rate environment, and so illustrated rates, not necessarily the actual product performance, lag that, creating unrealistic projections forward in time where one thing is not looking good while the other thing, interest rates, is going up rapidly. I think I have to state at the beginning, this is a more technical presentation. We will do a non-technical version of this, so if you're a geek, listen in, hit the subscribe button, enjoy. If you're a non-geek, you might want to wait for the translated version of it. For those who are selling whole life, IUL, universal life products, this is required knowledge so that you can explain to your clients why things work the way they do. There are clients, however, who are much more knowledgeable about how financial products work, and this will also be extremely useful for you. I have to restate that an important theme of what I'm going to talk about today is not covered by illustrations. Illustrations take a moment in time, even though the products are impacted by interest rates, and assume they'll never change. Just by way of example, imagine the S&P did 2% this year. The way an illustration would work is say, therefore, for the rest of your life, the S&P will do 2%, even though you know it gets different returns every year, or even if it's a fixed income product, will go up and down with interest rates. Understand that just from the regulatory point of view, a life insurance illustration will never change the underlying economic conditions that are behind it. Before we go any further, I want to introduce some of the language that's common for those in fixed income, but not as common for those who don't get out of bed in the morning with their coffee and think, I think bonds are a really interesting conversation, which is probably 99.99% of the population. So what is a bond? A bond is just a loan. It's a loan typically by a corporation, a government, or somebody who issues a note for a certain amount of debt. And let's just imagine that it's $100. And obviously, if I'm going to borrow money from you or anybody else, I'm going to have to pay you some interest. And so they typically fix the amount of money that they are going to pay, which is why it's called fixed income. And they're doing that so they know exactly how much that loan is going to cost them. So let's say in this example, I will pay you $4 a year for the duration of that loan. Let's say a 5-year or a 10-year loan. And so what we typically call that is the coupon rate. Or if I give you your coupon with a little stamp on it, it says, I'll promise to pay you $4 for every $100 every year for the next 10 years or however long it is. Okay? However, interest rates go up and down. And so imagine that if I had a rising interest rate environment and the interest rates went to 6%, obviously nobody's going to buy my 4% rate of return. And so the yield is the current amount of interest that I have to pay on that note. Well, I've got a problem. If you think about it, I've got a $100 note that's promising to pay you $4, but the prevailing interest rate is 6, so the maths doesn't add up. So the way that bond market adjusts that is they adjust the sale value of the note itself. And this is called mark to market. So they'll adjust the price of that $100 note. So let's look at it logically. I've borrowed some money from you. You have a note from me, but you decide you want to sell it, but you have to sell it at a loss in this example because interest rates have gone up. So I have to discount the note so the effective rate becomes 6%. And there's some complex maths behind that, but the basic version would be, hey, if I sell my $100 note at $66, paying out $4 a year, now my rate is 6%. It's also important to understand that the bond market is massive. It is way bigger than the stock market. And billions and billions of this are transferred every month. So in other words, bonds are a safety net product. The idea is you can sell them quickly. And so that's why this kind of transaction takes place. Now, this is important because the whole life product, the index universal life product, and the universal life product all have the majority of your cash value, and the premium you pay that goes into cash value is sitting in bonds. But because life insurance carriers hold those bonds until they mature, they account for them differently and pay the return on them differently. So bonds outside that you might have in your investment portfolio will go up and down daily. You can't listen to the news today right now and not hear every day how the 2-year and the 10-year treasury are going up and down like a yo-yo. That does not happen inside life insurance. And that is both an advantage and a disadvantage. So imagine you have a general account, and imagine that, for simplicity's sake, obviously it's a little bit more complex than this, but imagine that a life insurance carrier had bought bonds for 3 years, and they had 3 buckets, and it was a rising rate environment. So they had one bucket with 4%, next 5 and 6, and so on. The new money rate, or the prevailing interest rate, is obviously 6%. But what the life insurance company does is just pay you the coupon rate. They just pay that fixed note amount that the original issue of the bond was saying. So in this example, and assuming these buckets are all the same size, the average of that would be 5%, not 6%. So you can see immediately that in a rising interest rate environment, the portfolio return that the life insurance company is paying you is lower than the prevailing rate. And when interest rates decline, the opposite is true. So it's both a blessing and a curse. However, the actual value of your cash value doesn't change with interest rates. And so one of the things that makes it extremely attractive for lenders in the financing space is they're not subject to that mark-to-market change. So again, it's a great advantage of life insurance, but it can lead to some disparity between what the general account or the portfolio of bonds that the carrier is sitting on and the prevailing interest rate. So just to put this on a simple kind of chart example, just imagine, pictorially, we have this rising rate environment. You can see that as the rates rise, and let's say rates keep going up to, say, 7%, as I sell my 4%, or as my 4% bonds mature and I pay, get the money back, so I buy new bonds and they will be at 7. So gradually my portfolio will go up with interest rates. Now, if I'm belaboring the point, it's because what we're finding is a lot of advisors look at a life insurance illustration and can't explain to their clients why this change is not reflected on illustrated rates. And it's largely a disconnect between economics as it really is and the regulatory environment that the industry has to abide by. So just understand that these products are inextricably linked to interest rates, even though the illustration doesn't reflect it, for both good and ill. So there's kind of like a bead theory, and this was just something we made up, but imagine somebody's holding a necklace, a pearl necklace, and on one side's lower than the other. So on the high side, these are bonds that I bought a long time ago, and on the low side, these are bonds I've been buying in the recent years when interest rates have been really low. So as the old ones mature, and I get the money back, I have to buy new ones, right? And so what happens is as interest rates start to rise, these old bonds are dropping off, and I'm buying new bonds at higher rates, but only when they get to parity with my portfolio rate actually start to become positive as a blended rate. So I kind of imagine this pearl necklace where you're kind of gradually doing this, or vice versa, is why there's this lag effect on portfolio rates. Doesn't mean there's anything bad about the product. It means it's kind of like a super tanker trying to change its direction quickly. And these are portfolios that are 30, 60, $80 billion in size, so they're huge. So when we look at this in the context of interest rates, what will happen then is in normal conditions, you'll have a spread between interest rates, which are a risk-free rate essentially, the treasury rate, and the bond portfolio, which pays a higher rate. And there's a natural spread there, and it's typically about 2% on average. So the lag effect kind of creates a squeeze. And that squeeze is just a transitory moment in time, but as the portfolio rate starts to respond, let's imagine interest rates go up suddenly as they have in the last 6 months. Portfolio rates don't respond that quickly. The supertanker takes time to turn. But as interest rates start to stabilize, as is forecasted in 2023 that they'll stabilize or decline, it doesn't matter which one it is, the portfolio rate will continue to rise. And that will go back to initially being better than it should be. You know, that spread will look better just because of this delay lag effect before it starts to normalize again. And depending on when you buy your life insurance product, it will take that moment in time and assume it never changes, and doesn't really reflect that over a 15-year period, these spreads are incredibly accurate. I mean, if you look at the averages, they don't change at all, but the illustration just kind of looks at that 1 year instead of the 15-year average that we look at for most of these life insurance designs. All right, so if we look at where historically we would expect the difference between the portfolio rate and underlying what used to be LIBOR, now is lots of different things depending on which bank you ask, but underlying federal funds rate, SOFR rates and so on, that spread is going to average around 2% depending on the rate you use. It will not change unless the entire economy changes the way it prices risk, which we've not been able to see any measurable change since 1928. I mean, this is pretty constant stuff. The other thing I want to point out is this is not just Daen's opinion of stuff. There's been lots of mathematical and economic modeling, but we've been here before. For those who are fortunately, like me, old enough, back in the 70s and 80s, interest rates went up, not as quickly as they are right now. I guess 1974, they went up quicker than they did now, but they went up to a very high interest rate. And what's not important here is the height of this particular curve, it's the lag. What we have on this goldy orange line is the prevailing rate that's, you see in the news every day is changing. And then if you look at the portfolio rate, there's a 4 to 5 year lag. Now, that doesn't mean no change at all. It just means there's this gradual response that happens over the 4-year period. And then when interest rates start to stabilize or go down, you get that lag, which means it actually goes above. And then as interest rates decline, the lag is in your favor. Why is this so crucial when we're talking about Kai-Zen? Well, the first thing I have to restate with Kai-Zen is Kai-Zen's tested to an 18% interest rate environment and could care less about what's going on right now. This is just noise, right? And over those 15 years that we anticipate having the loan in place with Kai-Zen, doesn't care, the averages will balance out. But when you're looking at IULs in particular, this is crucially important. The IUL takes that portfolio return, the yield or the blended coupon rate of the general account, as the life insurance industry calls it. You and I would just call it a glorified bond portfolio that's really, really big. And what it does is it says, I promise you that I will have a 0% floor. That's nice. It gives you a lower end return protection. So while it's tracking change in the market, you don't get the downside. That's nice. But the way they're mechanically doing it is they're saying, how much do I have of the cash value do I have to put into bonds so that with that portfolio return, I bring you back to par? Now, I'm ignoring contract costs just to keep this simple. And so the leftover money is what we call option budget. That's buying the upside of that market index, whichever one it is, S&P or other. So if you think about it logically, as interest rates go up, I don't have to put as much money into my bond portfolio to bring it back to par each year. In other words, what I'm putting into my cash value is being heavily dictated by the prevailing interest rate and its effect on the general account. And so if we go back to an 80s, for example, general accounts weren't playing around in the 4 to 5% range. They were in the 12 to 15% range because prevailing interest rates were so high. Man, would they dream to have those now. So we get a sudden rate rise, we'll get portfolio rates that go much higher than they are today, which translates into having more money to spend on an option to give you more of the upside. Now, there are naysayers out there, and the prevailing naysayer comment on that is, that's great, but as interest rates go up, so the cost of the option goes up. And in classical economic theory, that's largely true. That's what the prevailing thought process is. But here's the bit that's not being said. Do they go up enough on average over time, not every single day, but do they go up enough to offset the increase that you're going to get? So what we would expect is that my option cost would go up unless you're in these things called low volatility options, which more and more carriers are coming out with. Low volatility options, no, they don't go up, which is why companies like Allianz and National Life Group have brought out various renditions of low volatility options, which is cleverer people than me. So those option prices don't change, or if they do, very little, so that more and more of that new upside budget comes through to give you more and more of the upside. That's a good thing in a rising rate environment. Obviously, the opposite is true in a declining interest rate environment. So if we take a time period, and this was data that has been published by several carriers, and if we take June, July of 2022, we have a rising interest rate environment, and volatility, which is the thing that drives up option pricing, went up as well. Historical volatility is around 19, 20, it's up around 30, so it's high, right? So what that would indicate is that all of this, if you were a naysayer, would say we cancel out by option pricing. So what do we actually see? Actually, we see that's not correct. The increase in the option price is not offsetting the increase in budget. So your caps, as we have observed with many of these carriers now, are raising their caps. The low volatility options are even better for that, and there are some carriers who haven't raised their caps yet, and the only reason for that is that bead theory I was telling you about, where their older bonds have not yet burnt off enough for their portfolio rate to be pulled through. It's just maths. It's not conspiracy theories, it's not politics, it's not anything else, it's just pure maths. So as my option budget goes up, what we now know is that I have more to buy the upside and I can get more and more growth. Again, none of this is forecasted. Now, this is particularly important when we're looking at financing, because obviously my loan cost is going up. My illustrated rate is saying I'm still pretending I'm in the low interest rate environment of 2 or 3 years ago. Obviously, there's a mismatch. And it's important that you're able to explain the interrelationship between interest rates and underlying product performance, because again, it's not reflected in illustrations. And so people obsess about the numbers projected out 20, 30 years, when in reality, they're going to change dramatically from what's being shown on the illustration. Generally speaking, and this is especially true for Kai-Zen, we would really like interest rates to go up, because the increase in option budget way more than offsets the increase in loan costs, but it takes time to balance out. I would much, as I'm a Kai-Zen holder of our family, have 8 policies. We would much prefer to have a loan rate environment of 6-7% than 1-2%, because from the upside capture of the IUL point of view, we get much, much better return, or the opportunity for much, much better return. And even in periods like the Great Depression or 1980s, or for those who remember 2000 or the banking crisis when the market crashes, there's nothing I would like more than a market crash followed by at some stage with a rebound where I have more and more ability to capture that rebound. So that's almost ideal. So let's look at what the client is worried about. We do a projection with an illustration. We do a projection with a loan. And then suddenly the loan rate starts to increase. So clients go, oh my goodness, is my policy going to crater? Is this all going to work? And this is fueled by either ill-informed or advisors who are trying to say, get out of whatever the other guy sold, buy my thing. But they don't say it that way. They say, everything you've got there is rubbish. Look at where interest rates are going. They just don't explain that the policy will respond. So what you then say is, okay, while I can't show it in an illustration, what do I now know about the underlying economics? Well, what it says is I've got an illustrated rate, but if underlying interest rates go up, unless the entire way the economy changes the way it operates, what's going to happen gradually over time is that my performance will improve until it stabilizes with the normal performance spread or the risk-reward spread between the two. There is a squeeze, for sure, for a period of time, but that actually balances out. And over a 15-year period, we couldn't find one where that 15-year average didn't hold true. And this is important because if that spread is expected to be about 225 basis points in the case of Kai-Zen, right now we're illustrating about 75 basis points, which didn't even happen in the Great Depression, and it's still showing a compelling value proposition. So great for Kai-Zen, and it's good, really robust, but it's really understating what it's really designed to do, and will, from all the data we can gather, both historical back testing and forward deterministic testing or Monte Carlo simulations, all of this bears out by what I just said. So, what does this mean for clients today? Well, for clients who are in a plan, this means plain sailing. As I said, we tested this for 18%. Bring on 6 because it means my policy will perform better over time. For new clients we're illustrating today, it means the illustrations don't look as attractive as they should be. As we come out of the rising interest rate and start to stabilize, there'll be a period of time when the designs can, if you have poor case designers, look more optimistic than they should be. NIW will not be doing that. That's a requirement of our case design team, that they will stay within economic modeling parameters. And then it will stabilize out to normal. And I can't state this enough, that over 15 years, all of this doesn't matter. So in a rising rate environment, you would expect the whole life, a universal life product, or an index universal life product to gradually improve their performance in a lagged fashion. I will say again that from a Kai-Zen point of view, when we were looking at it, designing it for our own personal consumption, we said, is there a likelihood that interest rates will stay low forever? No flipping way. They are going to go up. We didn't know when, we didn't know by how much, so we just said, let's just assume the worst and assume it's going to go to 18% and go there really quickly. And we built that into the design. That's cool. It's important that if you're an advisor, that even if your client is not, a finance guru or anything like that, that you explain in their language the underlying economics that makes them understand and feel comfortable that this has been thought through. Rising rates is not a concern. The rate of change makes it difficult for a relatively short period of time from an illustration point of view, not from a performance point of view. And what that implies is that designs need to look beyond the illustration. And hopefully I've given an indication that certainly in the Kai-Zen and our traditional premium financing space, we have considered this and been doing this for 22 years. So yeah, we've thought about this a lot. So the bad news is illustrating for the next 6 to 12 months won't look as attractive as it should do. The good news is that life carriers are raising rates at a much faster rate than we ever anticipated. So they, cleverer people than us were way ahead of this. So that's actually positive because it means that they're ahead of plan. And it means that rising rates should be exciting to clients who have designs like Kai-Zen that are very solidly constructed. And even better if the market happens to have tanked in the meantime because you'll capture more of that upside. Let's look at it. If you're in an index and you're actually investing, you're 20-30% down this year. From an IUL point of view, 0. Okay, you didn't take a big loss. But when the market rebounds, whether it's next year or the year after, don't know, you capture a very positive return, and you capture more of it because your cap or your participation rate has gone up, so you capture more of it. I'll take that investment return any day. You just need to feel comfortable and understand it, that the world works that way. And finally, the really, really good news is when we built Kai-Zen, we built it with exactly this environment in mind. I hope you found this interesting. For more information on this, just if you need follow-up questions, contact marketing@niwcorp.com or go to NIW Corp. Don't forget to hit the subscribe if you want to continue to be invited to these and you find these informational webinars on podcasts useful. And we would love your feedback. Thank you.